Hello everyone out there, this is Peter Harris from Commercial Property Advisors, also author of this book, Commercial Real Estate Investing for Dummies, and coach and mentor to many commercial real estate investors all across this great nation of ours. The title and subject of today's video is 7 Commercial Real Estate Terms You Should Know. I want to start here today, and there's a quote from Greek philosopher Aristotle, and he says that educating the mind without educating the heart is no education at all. I agree with that. So in this video, I'm going to share with you and teach you 7 terms, 7 commercial real estate terms that are at the heart of every commercial deal that you will run across. So do not buy or invest into any commercial real estate deal until you understand these terms. Okay? All right, let's jump into the first of 7 terms that you must know. This first term is called the net operating income, also known as the NOI. The NOI is a very important term. It is the heart of any commercial deal that you're going to evaluate. So it is at the heart of the evaluation of a commercial deal. It is a driver of what a property is worth, what it's going to be worth in the future, what the cash flow is going to be, and also how you're going to make an offer. So it's a very important number. Now, let me give you an example of how to calculate it before I go into the why. Okay? So here's an example. Let's say that your rental income is $200,000. Okay? Now this is per year. Okay? Rental income of $200,000 per year. Let's say that you have expenses of $100,000, okay, per year. Okay, gross rental income of $200,000, and your expenses are $100,000 per year. Your expenses include property management, payroll, repairs and maintenance, taxes, insurance. Does not include your mortgage. Okay, your mortgage is not an operating expense; it's a financing expense. Okay, so $200,000 minus $100,000 equals your NOI. So your NOI is your income minus your expenses. Okay, so here's your NOI. Very important number and how to calculate. Now you know how to calculate it. Here's the reason why it's so important. As your NOI goes up, okay, your cash flow not only goes up, but your property value goes up. And conversely, if your NOI drops, if it decreases, your cash flow goes down and your property value goes down. Okay? So that's the correlation. That's why you want to make sure that when you buy a commercial property value that your NOI is always going up, at least staying steady, but always going up. Now, here's a technique or strategy that's very powerful that we teach our students. It's called the commercial cash out refinance. And basically what we're doing here is we are finding, locating, and evaluating and thusly buying a property where we can increase the rents and increase the NOI. And once we do that, we have a higher NOI, we have a higher cash flow, a higher value. We can refinance the property, pull out the original down payment, or if the investors invest into it, we will pull out enough money to pay back to investors, right? And then once you have a property where you have no money in, what is return on investment? It's infinity, right? So that's the power of the NOI. So the higher the NOI, the higher the property value, you can refinance and pull all the money out that you put into it. Again, that's the power of the NOI. The second thing I want to share with you is this age-old formula here that you know from my previous videos, and I know you watched my previous videos, right? So this calculation is called the cap rate is equal to the NOI divided by the sales price, or here the value, okay? You know this. Now, what I want to teach you here is we can figure out the value if we know the NOI, we know the cap rate. Let me switch this formula up for you and show you the power of this, okay? Pardon my back here. Okay, so value is equal to NOI divided by the cap rate. All right, so all I did was I flipped this cap rate equation over, right? So value is now equal to the NOI by the cap rate. The reason why this is important is you need to be able to calculate property values in order to make an offer or to figure out what a property is worth or what it's worth in the future. And this is how you do it. Let's say we use this example. Let's say I'm in where I am here. Let's say everything here is a 6% cap rate, okay, in the area that I'm buying. And it's a very common cap rate in this country, right? 6%. So let's say the cap rate is 6%, okay? And I know the NOI, right? The NOI is 100,000, okay? So this formula here, the value is equal to NOI divided by the cap rate. The NOI is 100,000. The cap rate is 6%. So basically my math is 100,000 divided by 6%. Do the math. It's $1.66 million, right? So so we have just calculated the property value. By the way, this is just one of the main ways an appraiser will calculate a property value. Now you know how to do that. Let's say, for example, that we bought this property for $1 million 2 years ago, and we increased the NOI from 80,000 to 100,000 over just raising the rents and doing some renovations, right? So we bought it for $1 million. We increased the NOI to 100,000, and now it's worth 1.6 million. Okay? So what I have just taught you was how to calculate a property value today and what it's worth in the future. That's the power of the NOI. All right. So hopefully you got all this. Let's move on to the second term everyone must know. All right. Here is the second of 7 commercial real estate terms that you need to know, and it is cash on cash return, also known as your return on investment or ROI. I'm sure it's a term that you've heard somewhere, someplace, okay? Cash on cash return is one of my favorite terms, right? And as I mentioned earlier, the first term was the net operating income, the NOI. That was the heart of your evaluation. The cash on cash is the heart of the money that goes into the investment. If you have investor money, that's the heart of the investor money. If you're using your money, it's the heart of your money going into the investment. Now, let me show you how to calculate the cash on cash return, or the ROI. Here's the formula here. Cash on cash is equal to the annual cash flow, okay, divided by your down payment. Let me do a quick example for you, okay? Pardon my back again. Let's say that your annual cash flow is $12,500 a year, and you put down $50,000. Okay, so the annual cash flow is $12,500 a year. Your down payment is $50,000. That equals, you do the math here, that equals a 25% return on investment. Okay, so that means that in 4 years, you are getting your money back. Okay, that's how fast the money is moving in 4 years. Okay, so you can do 4 years of $12,500. It will equal your $50,000 injection to the property. Okay, so 25% equals 4 years. Now let me share with you why this is such an important term and why it's my favorite. Look at this quote I wrote here. Okay, it's not about how much money that goes into the property, but it's more about how fast the money comes out of the property. Okay, very important. This is known as the velocity of your money. Again, my favorite term. Let me give you a quick example. Let's go back to this example here. Let's say that on this property, I'm still putting in $50,000, but my cash flow is $2,500 a year, okay? But I still put in $50,000, okay? So that gives me a 5% return. For some people, that may be okay. If you play the stock market or paper investments, you may be okay with that. But in commercial real estate, we do nothing that's not a double-digit return. Some of you may think I'm crazy or far-reaching, but it's not the case. If one of our deals does not produce at least a 10% return or 10% cash to cash, we don't do it, plain and simple. 5% return means that you're getting your money back in 20 years. Not too exciting, right? Would you want to wait 20 years to get your investment back through cash flow? No, you probably not. Let me give you an example of how fast the money can move here. Right? So let's say in this example here, where it produces $12,500 a year in cash flow, let's say, for example, you went ahead and you raised the rents, you did some renovations, and you bumped up the rent, and now your cash flow is double this. Let's say it is now, instead of $12,500, it is $25,000 a year. You still put in the $50,000. Okay, that will give you a 50% cash-on-cash return. All right, that means you're getting your money back in 2 years. Okay, some of you may think I'm crazy for even writing on a board that there's such thing as a 50% cash-on-cash return, but guess what? I challenge you to find a very successful apartment syndicator out there who's very successful, right? Interview him, ask him what his cash-on-cash returns are for each year or for the life of his investment, right? And his cash-on-cash returns, this 25%, this 50%, or even more are achievable. I challenge you to find a good syndicator out there, a person who puts together other person's monies and goes out and buys value-add opportunities, apartment buildings. I guarantee you, you will see returns like this. All right? So again, this is why the cash-on-cash return is my favorite term. All right, so let's move on to the third commercial real estate term that you should know. All right, here is the third of 7 commercial real estate terms that you must know. It is called the capitalization rate, or for short, we call it the cap rate. Now, number 2 was the cash-on-cash return, which is return on investment. That was the heart of the money going into the investment. The cap rate is, if there could be a term that is the heart of the industry in terms of a singular calculation, it would be the capitalization rate, or the cap rate. The cap rate formula is NOI divided by the sales price. It is an industry-wide term. Okay? Everyone in commercial uses this term to evaluate a commercial property. Now, in terms of a layman's definition or an easy definition, I've come up with this here. A cap rate is basically your ROI if you paid all cash for the property. So if you paid all cash for the property, meaning there's no mortgage, what's your return on investment? All right? So if you have a $1.25 million property and you paid all cash for it, right? What's your return on your $1.25 million? Let me give you an example. Okay, so the cap rate is equal to, let's say the NOI is $100,000. Okay, and the purchase price is $1,250,000. Okay, so here again, the NOI is $100,000 divided by the sales price, which is $1.25 million. Okay, that's the calculation for the cap rate. That is equal to 8%. Okay, so this $1.25 million that produces a NOI of $100,000 produces an 8% cap rate. Got it? Okay, now let me share with you why this is important to know. In my previous videos, I go way into depth on cap rates. In this video, in this section, I'm going to abbreviate it because I just want to touch over the high level, most important things. Here's why you must know this term. As the cap rate goes up, okay? So if you find a property where the cap rate is high or it's increasing, that means the ROI can go up, but what else? Guess what else goes up? Your risk goes up. Because as you go higher in cap rate, the neighborhood gets worse and worse. And conversely, if the cap rate goes lower and lower and lower, the neighborhood gets better and the risk goes lower and lower and lower. That's probably the most meaningful correlation I can make for you. Now let me define what's high and what's low. In my opinion, a high cap rate is a 10, 11, 12% cap rate. That's a high cap rate to me, right? So that's a high cap rate. A low cap rate for me would be 6, 5, and 4. I will consider that a low cap rate. So in those high cap rate areas, you're going to have the challenging neighborhoods. in the low cap rate neighborhoods will be the neighborhoods you probably would live in. Okay? All right, so that's the correlation there. Now, another important reason that you must know this term is I don't want you to be fooled. It says here, don't be fooled. Don't be fooled with what, Peter? Right? Don't be fooled with deals that advertise as high cap rate deals, meaning 11, 12, 14% cap rate. All right, those deals, for example, if you see them advertised, they're advertised for a reason because no one else bought them. But other than that, if it's a high cap rate deal, be careful. There's probably something majorly wrong with the deal. So don't be fooled, because most times a high cap rate deal is in a very challenging neighborhood, maybe even a bad neighborhood. And there's a quote here I'm going to share from you from a very successful person who bought a lot of bad properties in neighborhoods, and some were good, some were bad. Here's this quote: "You can't manage your way out of a bad neighborhood." That is so true. It's not that your management is bad. It's not that your strategies are bad. It's the culture of the neighborhood that prohibits you from managing successfully. All right. So again, don't be fooled. If you find a high cap rate property, 12, 13, 14%, put the brakes on, examine it very harshly, get a mentor, get someone who's very experienced on making sure that this investment will work and as safe as it can be. All right, okay, let's move on to number 4. Welcome to number 4 of 7 commercial real estate terms you should know. Number 4 is debt coverage ratio, also known as DCR for short. What I mean by debt here is your mortgage payments on the property, or you're about to put on the property. If your mortgage payments are $1,000 a month, then the debt here is 1,000 times 12 months, which is 12,000. Okay, so annual debt here. Now, when you think about commercial, and you think about financing, at the heart of it all is the DCR, the debt coverage ratio. Let me explain. The debt coverage ratio, if I could give you a simple explanation, it would be the amount of cash flow left over after paying the mortgage. Got it? Or it would be how well does your net operating income, how well does your NOI cover the mortgage, right? Here's the formula. The DCR is equal to the NOI divided by your annual debt service. Now, let me do the calculation for you so you can see. Let's say that your NOI is $100,000. I'll keep it consistent for us. And your annual debt service is $80,000. So again, your NOI is $100,000 a year. Your annual mortgage payments are $80,000. If you do the math here, right, it comes out to be 1.25. That's a multiple. That means that your NOI covers your mortgage payments by 1.25 times. Very important number. Now, why is that important? Well, again, in the world of commercial real estate and financing, your lender is going to look at DCR as the first check. They're going to do this calculation when they decide this is a deal they want to do or not. They will like your minimum to be 1.20. If you drop below 1.20, your lender is going to ask you to put down a larger down payment, and that could affect your return on investment, right? So this is why this is a very important term you need to know. Now, a good target, this is my guideline, a good target would be to produce a deal that has a debt coverage ratio minimum of 1.4 to 1.5. In my opinion, that's a really strong deal. All right, so 1.4 to 1.5 and upward, very strong deal. You get great financing. The last thing I want to share is, let me give you a correlation on debt coverage ratio and how it pertains to your deal and how you can make it better. As your DCR goes up, all right, so as this number increases, guess what happens? It's potentially possible that your down payment can go, because as this number gets higher and you're able to cover the mortgage better, that means your cash flow goes up. That means the lender is willing to give you more loan dollars, making your down payment go down. All right, so that's the correlation here. Now, that is debt coverage ratio. Again, it's a very important number if you really want to understand or begin to understand the correlation and what's in the heart of commercial real estate and financing. It's DCR. All right, so let's go to number 5. Here we are, number 5 of 7 really important commercial real estate terms that you must know. Number 5 is price per unit or price per square foot. What is that? I will share that in a moment, but these two terms are at the heart of determining what a property is worth and what you should make an offer on. All right? So worth and offer price is at the heart of these two terms. Now, how do you determine price per unit and price per square foot? Let me start here. These two terms pertain to your submarket or to your neighborhood. In different neighborhoods, you will have a different price per unit as well as a different price per square foot. All right, so these two terms will be different in respective neighborhoods. So I want you to be an expert in your neighborhood because prices are different in different neighborhoods. Got it? Okay, now let's continue. To figure out a price per unit, here's the formula here. Price divided by the number of units. $500,000 purchase price divided by 10 units equals $50,000 a unit. Sometimes $50,000 a unit can be referred to as $50,000 per door. Okay? And for a retail, commercial building or an office building, we can use this. The price per square foot. Okay? So the price is $500,000. The square footage is 10,000 square feet. So 500,000 divided by 10,000 is $50 per square foot. All right, got it? So now you know how to determine price per unit and price per square foot. It's really important because remember, they only pertain to your submarket, to your neighborhood. Got it? Okay, here's why it's important. If you know the price per unit in your submarket, it will help you gauge your offer price. If you recall earlier, I discussed with you how to determine a property value or a sales price by using the income method. If you recall, the formula was value or sales price is equal to NOI divided by the cap rate. Recall that a few minutes ago? Well, that was the first way that an appraiser would use in determining the value of a commercial property. This is the second way. This is known as the sales method or comparable sales method. The first one was the income method. This is the comparable sales method, where you would gather 3 comparable properties and you would average out the price per unit and you would compare it to yours. So if your average came out to be $50,000 per unit, you don't want to offer more than $50,000 per unit because the other properties have sold for this. So knowing the price per unit or price per square foot will help you make sure you don't overpay. Okay? That's the importance of knowing these two numbers in your submarket. Next, here's a question to ask yourself. Is the asking price realistic? So what the broker or seller is asking for to sell their property to you, is it realistic? You would know if it was realistic or not if you knew these two numbers in your submarket. Okay? Hopefully that's starting to sink in now. Lastly, if you are a commercial wholesaler, we teach that in our company. Basically, we break it down to 3 steps. Number 1 is find a good deal. Number 2, get it under contract. And number 3, find a buyer and flip it to the buyer. So that's commercial wholesaling 101. So if you are a commercial wholesaler, by knowing the price per unit or price per square foot in your submarket, you'll know if you have a good deal or not. That's a very, very valuable skill to have to position yourself to make a lot of money when you commercial wholesale a property. So again, price per unit and price per square foot in your submarket is at the heart of determining what a property is worth and what your offer price will be. So let's move on to number 6. All right, number 6 of 7 commercial real estate terms that you must know, that you should know. Number 6 is building classification. How do we classify commercial buildings? Well, we put them in a box, and that box is called an A box, a B box, and a C box. Actually, we call those classes. So we have an A class building, a B class building, and a C class building. Now let's see what each one is about, and we also discover why you need to be able to put these different buildings in different boxes, because they mean different things to different types of investors. Number one, an A-class building is the newest building around, brand new, beautiful, shiny. It's in the best location, all right, and the highest rents. All of you have seen, as you've driven downtown, the downtown beautiful apartment buildings with commercial on the bottom, highest rents, and very just beautiful buildings, right? So those are considered A-class buildings. Now, a notch down from the A class is the B class, all right? It's the next notch down. It's older, but it's still good. You have working class people in there. It's not a bad building, but it's not as beautiful as this building, okay? It's kind of an average looking building with quote unquote average tenants, okay? Now, below the B class, we have the C class building. C class buildings, they're the oldest buildings. You have the lowest rents. Most times the building needs upgrades, and inside the buildings you have maybe lower to middle income tenants. So that's how we determine A class, B class, and C class. Now there is also a D, as in dog, a D class. That's a class that's really not officially a class, but that's a property where it's probably mostly vacant or nearly all vacant, gang type of neighborhoods. We do not mess with those properties, all right? So as a beginner, don't go there. Now here's why we need to really understand why we fit a certain building in a certain classification. Number one, if you look at an A-class building, they're not for you. Let's look at an A-class office building. It is sitting downtown. It is beautiful. It's a skyscraper. It's probably $50 to $100 million in value. It is where I live. And it's not for you. And the reason why is these institutional buyers, these funds from here and overseas, those are the buyers. So they're okay with the 5% return, with 2% return. And they pay 50% down payment. And they're okay with the lower returns. They just want the asset. So that building is not for you, especially if you're a beginning investor. So we tend to leave the A class alone for those type of buyers. The B class is where we want to begin to play. The B class are the most stable properties. They're for you, all right? Now here's a goal with the B class. The goal for you is to find a B class property in an A neighborhood, all right? So if you can find a B class property in a neighborhood, fix it up so you can get A class rents, you have a winner. Got it? So go look for a B class property, fix it up in an A neighborhood, raise the rents, and you'll make a lot of money. Next is C class. C class for apartments. Imagine C class apartments where you have lower to middle income people. There will always be a demand for this type of apartment building in our country. Always. All right. In fact, these days, because of the prices compared to the B and C, these are probably the most profitable today because of the high prices of A's and B's today and the demand for them. But imagine a C-class apartment with decent rents. You cannot afford to build brand new C-class apartments. You can't, because the rents are too low and the building cost is too high. So C-class is the way to go if you're looking for a cash flow and if you're looking for the highest potential for cash flow. But there's a warning here. Be careful if you approach C-class, because C-class can have a lot of rehab, a lot of renovation, and it could be in a challenging neighborhood with challenging tenants. So you need skill, you need a mentor, you need an advisor to buy C-class properties in C-class neighborhoods. All right? So now, hopefully, you know how to place a property into the A box, the B box, and the C box. And now you understand why they're in those boxes. All right, so let's go to number 7, which is the 7th and final commercial real estate term you must know. Okay, here we are, number 7 of 7 commercial real estate terms that you Must know. Number 7 is you must know the type of leases that you have in the building. And the reason why is, imagine you're buying this big property that's cash flowing. What gives you the right to collect the income on the property, right? You're in a cash flow business. What gives you the right to take your tenant to court if they don't pay, right? If you have a legal instrument or a lease, you have no right to collect. You're out of business. That's the purpose and the importance of a lease. So basically, a lease is a written agreement between the landlord and tenant. It's a legally binding agreement. Now, in an apartment building, we have leases, right? And by the way, all of our leases are approved and written by our attorneys. And for an apartment building, a lease could be a month-to-month lease, it could be a 12-month lease, or it could be a 9-month lease, either or. And they're all good, they all serve their purpose. For something like an office building or a retail center, we have different types of leases here. We have a full service lease, we have a triple net lease, and we have a modified gross lease. Let me briefly explain this to you. I go in detail in other videos, previous videos on all these 3 different leases, but just for the sake of brevity, a full service lease means that the landlord pays for everything: insurance, taxes, repairs, utilities, all that he pays for. The tenant just pays him a flat fee. The triple net lease is the opposite, where the tenant pays for everything, right? And the landlord pays for nothing other than his mortgage. So if you're looking for something super passive, this is the way to go, right? Triple net lease. A modified gross lease is in between your full service and triple net lease. So the tenant and the landlord, they split certain expenses. That's what a modified gross lease is. Now, let me share with you why it's important, so important, to understand leases, or the types of leases you're going to get yourself involved in when you buy commercial property. Now, I'm going to use this description here. Imagine we have a human heart, okay? And the human heart, we have a left artery and we have a right artery. And imagine human hearts, through the left artery and the right artery, 2,000 gallons of blood flow through it every day, every day. Imagine one or both of these arteries get clogged or stop working or just fall away. You will cease to exist. You will, right? Because there's no blood flowing through your body. Now, imagine that your building, your commercial building, is your heart. And you have a left artery and you have a right artery, okay? And these arteries, left and right artery, where everything flows through, where your blood is now money. If the money stops, then this building will cease to exist. Foreclosure, right? So this artery here and this artery here are your leases. That's how important your leases are, okay? They're like the arteries to your heart. Now let me finish with this. I took a very long and lengthy and difficult class on leasing commercial property. It's very complex, a lot of legal terms. And let me give you the bottom line. Here's the truth. The professor told me, Peter, imagine that you're buying $1 million property. And what you're doing is to look at the importance of the leases. What you're doing is you're buying the leases for $1 million and the building comes for free. Got it? That's how important it is. So the building leases are worth $1 million and the building is worth nothing without the leases. All right? That's how important leases are. So that's why you must understand and read every single lease that you get. All right? So that's the important. That's why I left that there. That's very important there, the last. All right. I told you this was the last term, but I'm going to give you a bonus term that's probably more important than all of these terms put together if you want to be a successful commercial real estate investor and have long-lasting success. All right, here we are, the 8th and probably the most important term. This 8th term gives meaning to the previous 7. This a turn makes it all work together and causes you to be successful. 3 questions here real quick. What gets you the best deals in the industry? I'm going to give you the answer in a second. What will convince a seller of a commercial property to work with you instead of others? And lastly, why would a commercial real estate broker send you his or her off-market deals or their pocket listings? Why would they do that? Well, let me tell you this. The answer is not money, right? Money will not get you the best deals. Money will not convince the seller to work with you only, and surely money will not have a broker send you all of his best deals. Money is not the answer. Here's the answer. Hold on one second. Okay, here's the answer. Commercial real estate is a relationship-based business. Yes, the answer is relationships. You must be able to nurture and develop relationships in the industry, okay? Relationships will get you the best deals. They will cause a seller to work with you only, and they will cause a broker to send you his or her best deals. This is a relationship-based business, so I want you to get good at developing and nurturing relationships in this industry with sellers, with brokers, with lenders, with property managers, all the above. You must have relationships with all of them to be successful and be long-lasting in this business. Okay? So that's probably the best term of them all, to make the previous 7 work together in harmony. All right? Okay. So if you want more videos like this, please go to our website, commercialpropertyadvisors.com, or simply subscribe to this YouTube channel. Thank you all for watching this latest video on 7 commercial real estate terms you must know. I will see you at the next video.